Welcome to TheMoneyPowers.tv. Today's date is July 8th, 2016. It is a Friday, and it will soon be 12:40 a.m. in the morning. All right, so I just caught wind that the Bank of England may be considering a major monetary policy change in the next week, and I want to share that with you. According to an article I read recently, it appears the Bank of England may cut interest rates next week, according to the financial markets. So the financial markets seem to be preparing itself for a rate cut. Now, I'm pretty sure that you know, but just in case that you don't, the United Kingdom has recently exited or recently had a vote to exit the European Union. And a move like that is completely unheard of. It's unprecedented. It's never happened before. So the financial markets aren't sure what to make of it. And it is possible such a move to exit the European Union could have a negative effect on the United Kingdom's economy. We don't know for sure, but a move like that could potentially slow down the economy somewhat. So what comes to mind is the employment or the labor force. Let's take a look at the labor market statistics for the United Kingdom to see what path they've been on recently. So I'm visiting the office, the Office for National Statistics for the United Kingdom. The most recent release was done in June 15th, 2016. So it's pretty current. According to the first section of this report, 55,000 more people have gotten jobs in the last 3 months in the United Kingdom, and 461,000 more people have gotten employed when compared to last year. So these are wonderful numbers. These are great numbers. According to this statistical report, 304,000 more people have gotten employed full-time when compared to last year. And 157,000 people have gotten part-time jobs. 157,000 more people have gotten part-time jobs when compared to last year. So the labor force seems to be getting stronger in the United Kingdom, and that's always a great sign for an economy. That's always a great sign. All right, let's see here. What information we have here? The unemployment rate was 5%, the lowest since August to October 2005. There you go. Not an all-time low, but a very low unemployment rate of 5%. That's great. This is great news. So the labor force in the United Kingdom seems to be doing pretty well. So if I were to look just upon the labor force, there's no need for the Bank of England to cut rates when their labor force is doing so well. So I would put this is definitely a strike against cutting interest rates. All right, so that's their labor statistics. Let's take a look at the central bank's website. Usually when interest rates are cut by a central bank, inflationary pressures tend to build. So one thing that I want to take a look at is the current inflation rate and their target. So I'm on the home page of the Bank of England's website, and as you can see, they have a target inflation rate of 2%. They want the United Kingdom to have an inflation rate of 2%. And currently, as you can see, it's at 0.3%, significantly lower than the target. So let's take a look here. Here's the CPI for the United Kingdom. the consumer price index, if you don't know, and it's at 0.3% as of late, which is very low, very low. So because the inflation rate or the CPI percentage is so low, this is actually a great reason for the Bank of England to actually cut rates. Because when you cut rates, when you cut interest rates, CPI percentages typically go higher. The inflation rate will go higher. So they definitely need to edge this up to be more in line with their target of 2%. So though the labor force numbers was a strike against cutting rates, the inflation rate numbers is a strike for cutting rates. And let's not forget about their quantitative easing program. So quantitative easing is typically, it means that the central bank is producing more currency. They are infusing the economy of the United Kingdom with 375 billion pounds. So they're infusing more money into the United Kingdom's economy. That is definitely an accommodative monetary policy position. So if you take that into consideration, you may not need to cut rates. So that's another strike against cutting rates. You have a quantitative easing policy currently active. You have a great labor market right now, but you do have a relatively low inflation rate, which should change with a quantitative easing program going on. So if I had to make a hunch, I don't see them cutting rates. They have a lot of good things going on for them. Quantitative easing, well, that's debatable if quantitative easing is a good thing, but they are infusing the United Kingdom's economy with more cash. Their labor market is good. Their inflation rate is currently very low, which should edge up over time because of the quantitative easing. But it appears, according to the article we just read, or we just visited, that the financial markets are preparing for a cut. So it seems that the global markets are ready for it. They're preparing for it, even though the fundamentals don't necessarily demand a cut, except for the inflation rate. So, a cut may happen. I don't know. So just prepare yourself for it. And yeah, that's what I wanted to share with you today. So this is TheMoneyPowers.tv. I'll talk to you later.